give it one more. So I'm going to give it one more minute. We're ticking up quite quickly on people are joining, so I'll start in about a minute's time. Okay, let's get started. Good morning, everyone. My name is Darren Allen. I'm a partner at Dentons and the head of the Business Crime and Investigations team, and I'm delighted to welcome you to our webinar this morning, looking at lessons learned from recent corporate scandals. As you will see, today's webinar is a joint presentation with our friends at Kroll, who, as you all know, is a leading global provider of risk solutions, and we have had the pleasure of working with Kroll on a number of occasions. If we can go to the next slide. Great. This is the structure of our webinar today. Our aim is to go through these particular areas in about 45 to 50 minutes, leaving hopefully 10-15 minutes for questions. In the usual fashion, we have a Q&A function, so if you have any particular questions, please raise them as we go along. Each of the speakers is happy to take questions as and when they're doing their particular slot. Alternatively, we'll have a question session at the end. So if I go to the next slide, and the one after that. So let me introduce you to our speakers. We have Maria Brachkovich, Neil Curtin, and Peter Tutton from Kroll. Maria is a senior associate working with me in the Business Crime Investigations team, and before joining Denton, she was at the criminal bar with a practice focusing on serious fraud and international crime. Neil is Managing Director and co-head of Region EMEA at Kroll. He joined Kroll in 2013 and ran the business intelligence practice, dealing for the most part with professional investors in either a pre-transactional dispute-related or capital markets context. Prior to this, he spent 27 years in investment banking, working on both sides of the Chinese wall, and currently sits on the board of 2 public companies in the UK. Peter's an associate managing director at the Kroll London Financial Investigations team. He's a fellow in the ACCA and a certified fraud examiner with 13 years of fraud investigations experience. His focus is in the banking sector, having worked on multiple fraud, financial crime and misconduct investigations in retail, commercial and central banks in the UK and overseas. So those are our speakers. We move to the next slide. And one more. When we started discussing this topic with Peter and Neil at the end of last year, we thought there would be interest in a session that raised awareness of the issues involved in recent corporate scandals involving both financial and non-financial matters that impacted the reputations, the company valuations, and sometimes even the company's existence. And if we look at previous recessions, we see we see huge scandals. Going back 2 sessions ago, albeit US recession, we saw WorldCom and Enron. The last recession, we saw Madoff and Stanford, amongst many others, of course. And in each recession, we see a number of common themes. So companies manipulating financial statements to bolster their share price or improve cash flow. Existing frauds being discovered. So, 2008 Madoff and the 50 billion Ponzi scheme, perfect example. And individuals involved in wrongdoing, sometimes knowingly, sometimes actually with the best of intentions. They just crossed the line, hoping to assist their company and not really realizing that they've done something wrong. And the role of senior management and non-executive directors in these kind of matters is is crucial. And as this slide indicates, we're already seeing examples of corporate scandals, both financial and non-financial, that have impacted the reputation and value of the companies involved. I don't intend to go through these in any great detail. I know some of the speakers will pick up some of these themes, but Wirecard, an amazing investigation by the FT over many years, which eventually resulted in Wirecard admitting that it had a 1.9 billion hole in its accounts. The share price had a high of 195 euros in 2018, and it went down to €1 in 2020. NMC Health, an Abu Dhabi-based hospital operator, where questions were raised by a US short seller, Muddy Waters, in which he highlighted accounting issues and which saw the shares of that company drop 42% in value, and 2.3 billion knocked off the company's value, and then eventually with the appointment of administrators. And then Boohoo, looking at non-financial issues, Boohoo, reputational damage due to rumors of supply chain working conditions, including sub-minimum wages and the lack of social distancing during COVID. And then Ted Baker, so you've got examples there of both financial and non-financial issues with allegations of forced hugging by the CEO, and then accounting issues. So we're seeing it already, and I think we're going to see much more of it as the year unfolds. If we move to the next slide. So I've touched upon many of these points. As I've indicated, corporate scandals are not new. We see them in every recession. I think a key difference in this particular recession is likely to be an increased focus on non-financial risks, and Neil will touch upon that in his comments. Obviously, early indication of issues, early identification of issues is key to mitigating risk, and I will look at that in my slot later on. Just as a caveat before we get going, I should say that the examples that we refer to today are based largely on media reports, and of course further evidence may come to light in some of these cases. But the aim today is to ask what we can learn from recent cases and how to respond when issues arise. So with that said, let me pass over to Peter to address some financial issues.
Thank you very much, Darren. Can you just skip on another slide? Thank you very much. And good morning and welcome everybody. As Darren mentioned, this is just really a thematic overview. We can't provide all the tools required to detect and mitigate the risk, but what we can do is try and bring to light some of the issues that have been identified, particularly on as I say, on a thematic basis, such that those charged with governance within an organisation may have the knowledge or certainly the recognition to be able to ask further questions should these be relevant to their organisation. When we're looking at the thematic issues, I reviewed both contemporary and historical cases, and while some aspects may appear sort of unbelievable in today's environment, there are still a number of commonalities between the frauds that were conducted 20, 25 years ago and some of the financial issues that are relevant today that I'll be touching upon. Whilst some of you, I'm sure most of you will probably be familiar with Cress's fraud triangle. The thematic issues did seem to touch upon most of the aspects that are reflected within it, and it remains a relevant model in considering the risks to your organisation as well as how to mitigate these risks. If I start at the bottom, we've got the incentive, pressure, or motivation aspects, and again, this is heavily driven by or can be influenced by those with governance roles. So what behaviours are encouraged? How are people incentivized or rewarded? Or on the other side of that coin, what pressure is there within the organisation to adopt a certain cultural position? Now, this is usually driven by performance metrics of senior management that are often linked to remuneration, and they will filter down within the organisation. Traditionally, you see things like sales targets, particularly aggressive sales targets leading to inappropriate behaviour, usually driven by the requirement to show growth or generate revenue at the upper levels within an org. As I say, the pressure there being the fear of being fired or sales being so closely linked to remuneration, that people are pressured into trying to either comply or meet certain targets, or have to find alternative employment. And as I say, this is a cultural issue that we see within organisations, and it's seen in a number of different examples. I think most recently the Wells Fargo scandal was a fairly extreme example of this. The second pillar is the rationalisation. This is also a cultural issue. It becomes part of this: everyone else is doing it, or it's for the good of the company. And once misconduct has been conducted once, the rationalisation becomes easier, and the pressure grows to maintain that position, lest you get caught out. And if there are people that are caught out, I think the punishment aspect of this is key. We have often seen issues being swept under the carpet, or a rap on the knuckles, which actually increases the opportunity for rationalisation and, as I say, drives certain cultural behaviours. The final piece of the triangle is the opportunity aspect. And this tends to be where most organisations focused. It focuses more on the control environment, but there is, as I say, there's another cultural issue that's relevant here. And certainly in looking at a number of these cases, there tends to be the power dynamic within an organisation and the control that certain individuals hold over the rest of the business. Major scandals usually have, a central person or a cabal of individuals who collude and work together in order to drive certain outputs within the organisation. The common denominator here is culture, and whilst this is predominantly a non-financial matter, if it's not understood and considered in its fullest, then it can quickly become a financial matter, and this is something that Neil's going to touch upon later. Can I skip on the slides, please? So looking at some of these common themes, I'll touch very lightly on the financial misrepresentation side of it. As I say, we're just trying to condense a large number of issues within a couple of bullet points here. But I think it's just worth noting that the ACFE and the Certified Fraud Examiners report to the nations last year, and it has done, I think, pretty much since the report's been published, identified financial misrepresentation as the least common, but with the highest median loss, with over $1 million per instance. So these issues tend to hit the headlines, and they tend to have a material impact within an organisation, hence the focus here. So some of the themes that we've seen in recent cases probably will not come as a surprise, such as inflated revenues or overstatement of profits due to inaccurate disclosure of costs. We've seen instances of forged documents being used in order to justify sort of revenue streams. And as most accountants will know, with every sort of credit that comes from a revenue stream, there's a corresponding debit. And that debit may be in debtors in cash, but it's usually put in a place in the accounts that makes it very difficult to identify. And certainly we've seen it being used or being hidden in sort of non-standard and opaque markets. And the use of sort of unnecessarily complex structures to justify the business model. Second point is the understatement of debt. I'm gonna change the order. I think for me the most difficult one to identify and what has come up again and again, in fact, the very first major fraud that I investigated, was National Bank of Tajikistan, had exactly this issue, which was the non-disclosure of contingent liabilities and off-balance sheet lending. By its very nature, in a lot of instances, they don't actually hit the accounts and they don't become known until it's almost too late. So things such as guarantees being provided, pledged assets not appropriately recorded. There's often collusion involved, and the one thing that I will say to this group is, for those that are charged with governance, There is an opportunity to work with sort of auditors and audit committees to ensure that they have the best opportunity and the necessary relationships to identify such issues. And the final piece I'll just touch upon here is the use of, second piece I'll touch upon with regard to debt is the use of funds. By its nature, cash is fungible and sometimes difficult to monitor. But there needs to be a robust control structure in place to understand how monies raised are used, whether lending, whether it's being used to cover holes within the organisation. We've seen lots of instances of debt being lost, or the provision of unsecured loans to related parties and the such like. And as I say, this is one of the key themes that we've seen. The last piece that I'll touch upon here is the overstatement or overvaluation of key assets. One of the key fundamentals in the Wirecard issue was the acquisition of the Indian subsidiary that I think was sold for about 10 times its value only weeks after it was initially purchased. And so, the necessary nature of due diligence and the use of opaque markets is a significant risk factor in relation to these acquisitions and valuations. We've also seen large cash assets in non-standard locations and stock write-downs as well, which were sort of indicative of lax controls over assets, how often they've been revalued and whether they've been accounted for in a prudent manner. And I think this last one is really key in relation to the current environment. There is a lot of, there is a lot of pressure on organisations. Obviously, most organisations have been impacted by the pandemic, and there will be the need to review whether values of stocks, prepayments, contract values, even IP are current and correct. And there may be disincentives within the organisation to do so, leading back to the sort of pressure and incentives aspects talked about earlier. Can I just skip on to the next slide, please? And the final piece, as I say, is just, I'll finish up by talking about some of the red flags here. Darren mentioned earlier this targeting by short sellers, and I think this is seems to be a relatively recent development. There is always the risk, of a coordinated short selling attack and the spread of misinformation. I think one of the most extreme examples in recent years was the attack on the Borussia Dortmund football team. I think there was a bus, their team bus was bombed, and it was initially believed to be a sort of jihadist terrorist attack, and it turned out to be an individual who was shorting their stock. However, I think in the most part, particularly if there is a continued, there is continued focus in the media, market analysts, their job is to spot when things don't look quite right. They do a lot of benchmarking against related companies within the same industry, and they are pretty good at understanding where things don't add up or are too good to be true. And that goes back to the Madoff scandal. I think on the first slide, we saw the book that was in relation to it was called Too Good to Be True. And I'll touch back on that in a second. And I think the key here is really how organizations respond to these short selling organizations. We've seen, aggressive media and PR response. I think FT reported that Wirecard was spending in the region of about 120 million a year trying to show it as a victim. I think, even looking back at Enron, they had a aggressive response to the media, and they banned certain banks from deals that asked questions. And I believe there were even employees at the banks that were fired at the request of Enron. I think it's important for organizations to listen to the statements carefully and understand whether there is any truth to the positions being provided by these short sellers. And those charged with governance would normally be in a position to oversee such reviews, normally with an independent party as well. Another red flag, and going back to this too good to be true, is this continued and exponential growth. And we've already seen how overly aggressive targets can lead to improper behaviour, and a fixation with stock price as well can often lead to management maybe going above and beyond what they should be allowed to do in order to meet certain targets. From my perspective, I think the most important aspect of this is obviously it's not a bad thing to have continued growth within an organization, but and this touches upon the last point, companies need to understand their business better. How is this growth being achieved? If it does have the too good to be true factor, obviously you want to identify and mitigate that issue as soon as possible. But if it is a genuine success, well, surely you want to replicate that across the business. So I think it's very well, it's very good advice to understand your business as best you can. And as I say, linked to the above is the use of opaque or non-core markets, particularly for revenue generation. Is the majority of your profit coming from, a subsidiary that is not part of your core business, and understanding what the drivers are to that and whether it can be replicated. Whilst there is often a good explanation for the use of offshore locations, it inherently has a higher risk factor due to the opacity of it. And I see quite often in my job, particularly within sort of banking frauds, that customers or collateral items, registered in these offshore locations with very little oversight or understanding of the underlying asset value. So here, sort of investigation and due diligence procedures can be absolutely key in understanding why these markets are used. Is there a genuine reason for it? And whether, as I say, whether these successes can be replicated or are worthy of further investigation. And with that, thank you very much. I will pass over to Neil to talk about some of the non-financial issues.
Thank you, Peter, and good morning, everybody. So one of the things that I want to just spend a few minutes on this morning relates to issues that I broadly classify as non-financial in nature. And to me, they are issues that, the way I would put it, generally sit outside the circle of a number of the sell-side analysts who focus on the P&L, they focus on the balance sheet, the cash flows, the earnings and the dividends. But these are issues that I think are getting nurtured by increasingly large amounts of well-informed research, regulatory guidelines and commentary that, in my view, cry out for and demand an ever-increasing share of board time. And whilst it's absolutely true that investors want returns and need returns, it's also true that they care much more now about how those returns are achieved. And when I was thinking about this session, I was reminded of an article that I saw relatively recently in the Financial Times. It was an article about two US state pension funds who were, the way the article read, stalling on an allocation to quite a well-known US private equity house. And the issue was not returns. In fact, this fund seemed to have done actually exceptionally well. But the issue revolved around, and the way it was described, was grappling with the ethics of how outsized returns had been achieved. There are various ways, I think, to define and look at corporate scandals, but there's no doubt, I think, that the secular trend is for a heightened level of media scrutiny and stakeholder engagement around ethics, behavior, conduct related issues, governance in the broader sense, and just a much broader assessment of the actions that are being taken to create value and generate returns. And in the listed sector, where naturally things are pretty visible, there are a number of recent examples of non-financial issues exposing cultural shortcomings, ethically poor behavior, and, to my earlier phrase, governance weaknesses. And one of the most obvious lessons, I think, is that the reputational consequences of these shortcomings, dare I say it, occurring on the watch of a board director could be quite significant. And at one end of the spectrum, they can be career limiting. And at another level, at the other end of the spectrum, they are issues that invite a great deal of scrutiny from both regulatory and law enforcement bodies. And invariably, a consequence of this is that an already fairly cautious buy side gets more nervous, possibly sells the equity or the debt at the first sniff of a problem. And on a wider basis, the access to money and the pool of investors that might consider actually investing in a company or acquiring a stock can reduce, with consequences on the rating of the paper and the cost of capital. So there are quite far-reaching consequences, I think. I think it's also true that the desired level of engagement from many investors, and this is not just a comment relating to the listed sector, is high. It's increasingly quite diverse in nature in terms of what they want to discuss, and increasingly orientated around issues such as risk and ESG in terms of nature, and really actually, I think, is quite probing, to be honest with you. All of which puts demands and pressures on boards. And I think legislation is clearly a driver in its various forms. I mean, climate would be a good, clear example of that now. But it's also clear to me that there are a number of factors driving investors to put a lot more scrutiny around these kind of things. Either way, I think if we're talking about lessons learned, I maintain that unfortunately there's quite a lot that can be learned by looking around, reading the media, closely observing what's happening to others who are unfortunate enough to encounter problems on their journey. And it is possible, I think, that many corporate scandals have some form of cultural shortcoming. Pete made a reference to this just now at their core. I mean, if we look back in the UK, we can see significant issues in some cases arising from cultural shortcomings. Often they relate to dominant influences in the boardroom or actually sometimes outside the boardroom. Big personalities, as Pete was saying just now, overly aggressive pressurizing of staff, one-dimensional incentivization schemes. There can be a number of reasons, and unfortunately I think I can say that not many boards experience this, but I think with a level of conviction I can say that if you are sitting on a board, whether you find it an easy thing to face or not, if those sorts of things are happening, my view is you probably have pretty good gut instinct that that's the case, actually. And dealing with it, I think, can be difficult. There's no doubt it's not straightforward, and I think, in my judgment, requires quite strong, actually, non-executive directors. And I find it quite interesting that on many occasions when we are asked to investigate or review something, one of the first things we're asked to look at is actually the independence of the board, whether the independent directors as badged truly are independent. This can be another area, I think, where, and I've seen a situation actually focused on this very recently, where we were asked to review a board decision that had been made and a recommendation that had been made to a group of shareholders. And it's another area where I think problems can start, and I think it's an area where actually investors are much more alive to this than they've been before. And you know, if we're being asked to look at that level of connectivity between individuals more often, you know, if they have got connectivity, if they have worked together in some sense in the past, I don't think that's a showstopper. It doesn't mean that they can't operate with independence, but it's often now part of the information set that people make a beeline for when they are looking to scrutinise board composition or some of the decision making that the boards make. One of the things that I think I can share with the audience this morning is that about 3 years ago, one of our colleagues at Kroll in the US talked to us about what she described as a cultural check. And that's institutional, primarily investors, who bolt into their pre-transactional due diligence a level of information gathering that's directed at a better understanding of the culture of a business. Particularly, I've seen it in a pre-acquisition related context. That was 3 years ago. We now see an increasing number of, I'd say, predominantly private equity investors in Europe trying to undertake similar exercises in their due diligence and understanding the culture of a business, the working environment. I referred to the phrase earlier, the ethics, the core values. And the board's commitment to those non-financial issues, I think, represents a rapidly growing area of interest in a pre-transactional context and a growing area actually of pre-transactional spend. And I think investors do demand high standards, tangible evidence of commitment. It's important that, you know, there's a lot of stuff around reporting requirements now that boards are being you know, asked to adhere to and fulfill. And whilst the value proposition centres on the financials and in a sense the economic performance of the business, there's no doubt about that. I feel that there is an increasingly large group of professional investors who believe in the premise that certainly businesses are easier to sell when these favourable attributes are embedded in them. And perhaps also there's an increasing body of academic research around that, particularly in the context of areas like ESG, would lend itself to a view that companies and indeed stocks perform better if they are, in the wider sense, ESG compliant. One other area where I think we've seen issues recently is supply chains. And again, you know, what's interesting for me is that we've seen them pretty close to home here in the UK. We may be a bit more used to seeing them in some of the emerging markets, but we've seen them here in the UK. Areas such as excessive working hours, poor pay, other forms of human rights abuse, apart from being unacceptable from a corporate conduct standpoint, create, again, significant reputational and financial damage. And big customers are very unforgiving of these corporate shortcomings, and you know, they will drop suppliers as quickly as sponsors drop sports stars these days for these sorts of issues. And I think the damage can be quite long lasting, actually. You could flick the slide over, actually, Sarah. I do expect to see corporate spend actually more money, to be honest with you, perhaps more time, I'm not sure, but more time, maybe more money on supply chain issues in 2021. Whether that's shortening supply chains, possibly in response to COVID-19 and the issues around that, or whether it's a much deeper look at their suppliers from an ethics standpoint. I think we're already seeing more corporates who are potentially and actually reaching for know-how and tools that can help them. And my just sort of final comment in this particular section is that, and again, under this sort of lessons that can be learned, I would be the first to probably say that I think the risk register is one of the drier documents in the boardroom, but the fact of the matter is that the nature of risk changes over time. It changes as conditions change, for sure, but it also changes as companies evolve and they grow. And I think one of the things I've realized actually over the last 8 years since I've been at Kroll is that I'm going to call them new or contemporary risks emerge. And I'll give you an example. 3 years ago, nobody was asking us to help them monitor their influencer networks, or for that matter, the social media profiles of individuals that were of interest. Now they do. I've seen some people call this value matching as a phrase. You know, do the values of the influencers, some of whom we might be paying money to, you know, do they match our own corporate values? Do they? You know, it might take a scandal. In fact, I think in one case it did take a scandal to find out. But my observation is some certain types of corporates are taking this very seriously, and routinely now we don't get asked for just a background check. We get asked for something more nuanced. You know, what public statements has this person made? What do they appear to stand for? You know, we've all seen situations where people's historic use of social media and people's historic public comments on issues cause problems. Pete used the common denominator phrase just now. My version of the common denominator is that the level of media interest in the non-financial issues that a company is operating with is higher than it's ever been before. And I think that, you know, fall foul in some sense of the word, and the bare minimum that you can expect is restricted access to capital. You know, fewer institutions will go there. And I've been very struck by the speed. You know, this is a general comment. It's not the same reaction in all cases, but I've been very struck by the speed with which, at the first hint of a problem, some professional investors in the listed arena will sell very quickly. You know, some, you know, will see it through, but people can react quite quickly. And I mean, maybe there'll be a question on short selling attacks, which Pete referred to once we finished. But you know, some of this stuff could be incredibly destabilizing to the ownership. Briefly back to the risk piece, the risk register. It's a core document. I mean, it evolves and it changes, but it is the foundation, in my view, for everything that happens in an effort to identify risks, how the risks are changing, and reduce the risk of mishaps. And I think having an engaged board of directors and the right blend is not an easy thing to achieve, actually. It's the right blend in terms of temperament, and it's the right blend in terms of skill sets. And I think one of the outputs that I expect to see as we go forward is not in an excessive way. I mean, hopefully in a measured and appropriate sense. I expect to see the number of independent reviews commissioned by boards go up. Again, we can perhaps talk about that a bit more, but and again, I can connect that, I think, to some of the things we've seen in the short selling environment over the last few years. So I'm going to pause there. I'm going to pass the baton, and we'll return to you know, any of that you would like to return to as an audience in the Q&A.
Thanks, Neil. Great. So in this part of the presentation, we are going to focus on investigations, and in particular 2 aspects. So how fraud is discovered, namely how these scandals come to light, and then also work through some of the key issues to think about when starting an investigation into such a scandal. So we set out there on this slide a couple of avenues of information which can lead to a scandal being broken. The first, and perhaps the most obvious, is internal and external auditors. And it's obviously part of an auditor's remit to flag any concerns that they have, including suspicions of fraud or misconduct. So it really is an obvious avenue of this type of information. But it also has some key limitations which are important to flag. Particularly external auditors will often rely on the board and the company providing them with a sufficiently complete set of documents and information to make their assessment. And they're also going to be relying on things like directors' representation letters. which means that auditors, particularly external auditors, are only ever as good as information that they're being given. And it reminds me of a recent project that I worked on where the head of projects failed to pass on accurate information about the cost of a new build. This went on for 3 years, and the external auditors didn't pick up on any of it. And actually looking at it, dissecting it after the event, it was clear that actually the external auditors, even doing a fantastic job, couldn't have picked up on it because the information simply wasn't in front of them. So it's important to bear that in mind when thinking about auditors as an avenue of information. The next obvious one is whistleblowing and leaks. And we've seen quite a bit of that in recent years. I understand that there was a whistleblower in Wirecard. There was also quite famously a whistleblower in the 1MDB scandal. So that first broke when a British journalist leaked a number of documents which suggested that there might be some sort of misconduct. And eventually that baton was picked up and an investigation was carried out. So this is a really important avenue for gaining information. Whistleblowers do, of course, throw up a fair number of issues which are important to consider if you're sitting on a board. The first and perhaps obvious one is that there is whistleblowing legislation which must be followed. And it's very easy to make a mistake in that regard. So obtaining legal advice on the next steps is key. There's also an issue, perhaps a slightly more sensitive issue to consider in relation to the why a whistleblower is coming forward, whether there are alternative motives, whether a whistleblower might have an axe to grind. These things are always important to sort of factor into that consideration when first receiving a whistleblowing account. That's not to say that a whistleblower shouldn't be listened to, of course not, but it's certainly something to add into the mix and something to consider. Incidentally, just from the market, we've heard that apparently there was a bit of a dip post-pandemic in whistleblowing, but my understanding is that actually this is now on the up. So it appears that now that people are getting used to the new normal, whistleblowing will probably continue to be a valuable and important avenue of information in discovering fraud. The third one, and this might sound a bit comical, but is in fact prevalent, is accident. So I've seen absolutely loads of examples of this. A fraud can go on for years and years and years, go completely undetected, and then someone makes a mistake. Someone either sends an email to the wrong person, or perhaps they go on holiday, they leave something lying around, and before you know it, the fraud is discovered, and it is completely accidental. Sadly, not influenced by corporate governance per se, but it's a really valuable and important avenue of information. But I think there's a statistic by the Association of Fraud Examiners which suggests that up to 8% of all frauds are actually simply discovered by accident. Next, there's also the external avenue information. So we're thinking about law enforcement, inquiries, discovering through litigation. In my experience, a business will probably know that something has gone wrong by the time that law enforcement gets involved. But that need not be the case. And actually, I've been involved where on the other side, there was an embarrassing situation where fraud or fraud-like behavior emerged during litigation, so during the disclosure or discovery process. And in that particular case, it was particularly embarrassing since it became painfully obvious that a JV partner was siphoning off funds to pay for handbags. And this all came out during disclosure and obviously created both problems for the other side in the litigation and I imagine more wider corporate governance problems. Lastly, and this is the one that's receiving a lot of information at the moment, particularly as we turn to working from home and as businesses start to think about how best to ensure that employees are properly monitored and that working relationship continues as it should, and that's technology. Obviously, everything we do now leaves a trail. That includes things that we do in real life. So if you're using your debit card to pay for something, if you're tapping into a building at work, but particularly it is true on the internet and on a computer. So all of this is valuable information that can be flagged up to discover fraud or discover misconduct. Apparently, this has really become prevalent with banks at the moment. So they're using lots of AI initiatives to try and flag up misconduct, particularly of workers who are working from home. And these things can be incredibly sophisticated. So I think they can be as sophisticated as looking at the types of documents that an employee has open up at the same time as working with a customer and flagging the types of information that they might be saving. Because all of these can sketch out that perhaps there might be something awry. So those are sort of the main avenues of information for discovering a fraud. We'll turn next to what to do when you've spotted those red flags. And as a matter of good corporate governance, you need to start thinking about at least a level of investigation to work out whether the concerns are merited. And this slide sets out just a few of those issues. It's not by any means exhaustive, but there are certain things that are worth thinking about in those early stages of an investigation. The first one is electronic evidence. You want to start preserving as much electronic evidence as possible. This might be sending around a do not destroy email. It might also be limiting access of certain employees to their email inboxes or to other systems. One of the key issues, particularly now that evidence and material can be saved in many different parts of an organization's systems, is to make sure that you've mapped all of those parts out. And that can be servers, it can also be cloud-based storage solutions. So it's a good idea to just pause and think about where your electronic evidence is being stored. The next thing to think about is who's going to investigate, who is the best team for that. The key issue there is obviously to ensure that an investigation team is clean so that there are no risks of conflicts, and there's no possibility that halfway through an investigation, it turns out that a key member of that team has actually been somehow involved. In the middle there, we've got LPP, so legal professional privilege. It is often a source of a lot of confusion and heartache for our clients, and it really needn't be. One of the things to remember is that only lawyers will attract LPP. So not accountants, not professional investigators, and certainly not just marking a document as subject to privilege, which is one of the most common mistakes that I see. It's also important to define who the client is for the purposes of LPP and keep it to a small group. And that's important to maintain the confidentiality of documents, because once the confidentiality of documents is blown, then so is their legal professional privilege. It's also important to think about disclosures either to law enforcement or potential third parties. And again, a frequent question that we see is, do we need to disclose to law enforcement as part of that, those first days or weeks of an investigation? And the general rule is that there's no obligation to report a crime. But obviously, as with any general rule, there are exceptions. One of the most obvious exceptions is if it's a company working in financial services. A company might also want to consider self-reporting in certain situations, and that might be where there's interest, for example, from the Serious Fraud Office. So reporting is one certainly to keep an eye on. It goes wider than law enforcement, of course, and there are also a number of other issues, such as reporting, self-reporting to the ICO, or regulators, insurers, and making sure that you are acting, for example, in line with insurance policy. I'm going to take the rest relatively quickly. I'm keeping an eye on the time there. Witnesses and interviews. Again, causes quite a few headaches in investigation, but it needn't. It's just important to think about who to interview, how, and when. I think the received wisdom in previous years was to interview the suspect last, but that might not always be feasible, and to be honest, it might not always be advisable. Sometimes it is best to simply sit down and have that interview first to see what the parameters of the investigation are likely to be. Media and communications. The main lesson that I've learned is, sadly, don't ask your lawyers to write a press release. No one wants to read a press release drafted by a lawyer. It's also unlikely that you'll want to read a press release drafted by the company. In this regard, it's usually a good idea to get the professionals involved and get a media and communications team in. And finally, reports and findings. So after the investigation is complete, what is the best way of communicating the findings to the board or to other stakeholders? So the written report has reigned supreme in this regard, but actually oral reports, which might be a bit cheaper, a bit quicker, and engage fewer privilege issues, are becoming more popular. So I want to leave enough time for questions, and I'll leave it there. But obviously, if there are any questions, then please do raise a hand or write it. Thank you.
Thanks, Maria. I'm going to go through these points really quickly because I want to leave time for questions. So if we go to the next slide. So this is just simply some points to think about in terms of preventative measures. Peter and Neil and Maria have touched upon some of these. So critical and skeptical mindset. As Peter said, question successes. Often successes are, that have no no drawbacks, nothing's happened which is adverse. Sometimes it just looks too good to be true. Governance frameworks, are there independent NEDs who offer constructive challenge? Is there a committee structure that looks at risk conduct issues? Does the business operate a 3 lines of defense model, and is each line appropriately resourced? So there's some of the issues that I would flag there. Neil emphasised risk assessments, risk register. That has to be a living document that's refreshed, in my view, refreshed regularly. Policies and procedures is an obvious one, but again, they need to be reviewed and reinforced. Due diligence on staff, third parties, partners, agents, that's all part and parcel of minimising the risk to the business of entering into arrangements with those entities. Internal and external audits, having a strong third line of defence with and robust external auditors. And we've seen a lot of the recent scandals have involved auditors who apparently have not spotted red flags, and so that certainly for those audit firms is a big issue. So quickly on to the next slide. Whistleblowing hotlines. There's been, I think, Maria mentioned whistleblowing hotlines. How independent is it? Is it well known and promoted? And what's the experience or perception of it? Do staff trust it? Neil mentioned culture compliance reviews, which I think is really interesting. Actually, maybe this will be a topic for discussion later. But what culture does the firm have? Is there a strong tone from the top? How does a business organize itself? How does it articulate, govern and manage its culture? How does it promote the right behaviors or respond to the wrong behaviors? And what's the staff's perception of the internal culture? And I think culture compliance reviews may become more commonplace as the focus shifts a little bit onto non-financial failings. Neil mentioned end-to-end supply chain reviews. Has due diligence being undertaken? Have risks been identified? Are there appropriate contractual provisions to minimise and mitigate risks? And Neil also mentioned pre-acquisition due diligence, focusing on the cultural aspects, softer matters like that. And then finally, training, which is an obvious one. Then hiring board members with a varied experience base and individuals that are going to be prepared to challenge the executives. So that's a very quick run through in order to catch up some time, which I think now leaves us just over 5 minutes for questions. We've had a couple of questions in so far. One, just actually an ask, which is, can we please share the presentation materials with the participants later? Yes, we can. So if you'd like a copy of the presentation materials, then please let us know, and we'll send those to you. We've had another question. Should the growth of SPACs, so I think that's special purpose acquisition companies, be a cause for concern? I'll open that out to the speakers. I haven't had any recent experience of SPACs. Of course, in the 1980s, there were I think that they were referred to as blank check companies. They're obviously companies created to either merge or acquire a business, and you pay money over in anticipation of an acquisition or a merger. My understanding is that that monies are often held in trust or escrow accounts, but it seems to me that there is a possibility there for that to be abused. But I don't have sufficient experience. I don't know whether anybody on the panel does.
I'm probably in broadly the same category as you, but I mean, obviously I'm aware that the SPACs, in a general sense, probably one of the hottest asset classes out there, particularly in the US. I mean, there's always seemed to me to be an axis here where the US marketplace and perhaps US investors had a much higher appetite for these kind of things than maybe investors do over here. I suppose the one thing I would say about SPACs is I don't have a strong view on whether the resurgence in the SPAC is a good thing or not, but I do think it would be wrong to tar all the SPACs with the same brush. I mean, if some of the negativity revolves around, issues, for example, such as the promote fees for the founders, not all SPACs do that, for example. And I think that there is a case actually for saying that there are people out there from, typically they're coming from, I guess, asset management backgrounds or industrial backgrounds. There is a case for saying that actually those people might be able to find value creating acquisitions, might be able to accelerate a process via the use of a SPAC, and might be able to generate significant value for the underlying investors in the SPAC. I mean, if the concerns are around the process speeds up, and maybe that as a result of the process speeding up, some of the due diligence, some of the longevity issues, they might not be quite as robust. I don't know. I'm not familiar with the rule book around the SPACs, but I do find it quite interesting that we're in this period where they have become quite hot again. But I am of the view that definitely would be wrong to class them all with the same brush. And I think, I do think there are some people out there who can use them as vehicles to find and make and execute on acquisitions and make people money. And that's, without me having had an in-depth look at SPACs, that's, I think, as far as I probably should go before I get onto dangerous territory this morning.
Thanks, Neil. I appreciate it. We've had another question from an old friend, David Skade, talking about his experience of NEDs, and if I can, I think his question is around training is required up to the NED level, particularly when dealing with those people in the business that have personal criminal liability, for example, money laundering reporting officers, who may not be provided with access to NEDs directly. And he wondered if anybody had experience in this area. Anybody would like to comment on that? Sorry, Neil, go on.
No, if I understand the question correctly, it's about training for the NEDs, yeah?
Well, effectively, but it's also, I think his experience is that NEDs do not engage enough with the business on financial crime issues.
Oh, I see, right. Yes, I think that might be right, actually. I think that might be right, but I think that to be honest, and there probably wasn't time to do it justice earlier on, but I'm again at risk of making a sweeping statement here for which I'll get killed, I'm sure. I actually do believe the composition of boardrooms is changing. I'm going to go as far as to say I think it probably needed to, but the skills and the blend of experience, so for example, wouldn't be necessarily appropriate. Again, one size doesn't fit all, but it wouldn't necessarily be appropriate to have a NED who was an expert in financial crime sitting on the board. It might be in some companies. But I do think that, I liken it a bit, I really do liken it a bit to, if you're in the business of trying to choose a school for your kid, probably if you're anything like me, all the considerations start at the top. So to me, it starts in the chair and configuring the right experience base and skill set for what the business is. I'm sorry to go back to the risk register, you know, because I need to get turned on for the risk register sometimes, but it is so pivotal. It really is so pivotal around this thing, that understanding what the risks are in the business and trying to configure an element of the NED representation around that with the accordant engagement that's required, I think it's crucial. I mean, I think it's crucial. And I think, you know, now is not the time for a discussion about ESG, but ESG feels to me like it's one of those things where the secular forces are so strong that I would argue some boards probably are crying out, and some boards have got them. I can see some board appointments being made that sort of almost like fit that bill. So I can't give you a definitive answer to your question, but to the sense of the question, I share your view. But I think the skill is how you configure the board rather than you know, almost like allocate tasks around the NEDs and expect them to do something that doesn't necessarily fit within their experience base or come naturally. I'm quite a strong believer in the fact that board composition is key. Go on, Darren.
You know, I tend to agree with that. I mean, David's involved in, I was going to say, David's involved in the financial services sector, and I tend to, I know exactly what he's saying, and that is that in that sector and in others, but particularly that sector with the focus of the FCA, an understanding of financial crime risk is essential, because that a lot of damage is being caused to firms and their reputation. And if boards aren't sufficiently aware of the issues that the MLRO deals with on a daily basis, then I think that's a real failing. I think it goes back to your point, Neil, about understanding the risks.
I would completely concur with that. I would completely concur, definitely. And I would expect, I mean, I absolutely would expect, I mean, I don't sit on the board of a financial services company. I have in the past, but I don't now. When I use the phrase probing around investor questions, I absolutely would expect now, today, and in the future, the kind of thing that you're referring to, Darren, and the kind of thing the question is referring to be part of the dialogue that the non-execs are expected to have with the investor base, without doubt.
Yeah, absolutely.
Anyway.
Okay, I'm conscious that we're now 2 minutes past 11, so thank you for all those people that that have held on for an extra 2 minutes. I can see that there are one or two other questions coming through. Apologies, we don't. I want to ensure that we don't detain people for longer than was billed. But if you have any questions arising from this presentation to any of the speakers, then please let us know. We'll happily address them separately. But thank you very much for attending. I hope you enjoyed the session. We enjoyed providing it to you, and we'll hopefully see you all soon. Thank you.
Thank you very much. Thank you.
Thank you.